So I've been trading for 5 years. I became profitable around 2.5 years in, and I flipped small accounts into big accounts. I've grown my personal account into over $300,000 in 1 year, and I've even gotten banned from prop firms for getting too big of payouts. I'm going to condense these 5 years of trading advice and knowledge that I've learned into just this one video that includes my full approach to trading, and this will be a long video, so you need focus to be able to watch it all the way through. If you don't have that, what chance do you even really have to become profitable in the first place?
First, we kind of need to understand why it's so important. Why do I talk about it so much? Everything is a skill. Technical analysis, risk management, psychology, learning to improve, learning how to learn. Everything is a skill. This skill of journaling, preparation is one of the most important skills. This is more important than like technical analysis or strategy because it gives you awareness. It actually allows you to get accurate feedback. So if we break down what learning actually is, everyone learns from mistakes. It's impossible to learn without feedback. It's impossible to learn quickly without accurate feedback. We all know trading is a game of probabilities. If we just compare trading as a skill to basketball as a similar skill or shooting a hoop, you take a trade, you make an action, that's an input. So you have an input, you take a trade, you make a shot in basketball. It gets processed, it results in an output. You either make that shot, it goes in, you take a trade, it results in a win. Very nice. But main key difference here between trading and any other sport or skill is that the input and the output is a little bit disconnected. Trading is a game of probabilities. You can make the perfect execution of a basketball shot and it will go in pretty much every time. If it's normal conditions, every time you make a good, highly well executed basketball shot, it will go in every time. But every time you make a trade, it's probabilities. Why is that? You're always working with uncertain or limited information. There's always going to be uncertainty there. If there was true certainty, like, I don't know, we'd all be billionaires, but you're working with probabilities. The market is made up of thousands, hundreds of thousands of individual people making decisions to buy or sell. And there's also algorithms that are also making decisions to buy or sell based on rules. But yeah, you have that. So how are we actually able to make money from trading if it's truly random? Well, it's not, because what's the main factor, the main variable in the markets? It's us, humans. Humans are one of the main variables in the markets. Are humans completely random? No. We are creatures of habit. We have certain psyches. There's a reason like 90%, 95% people fail. It's because they're human. Not because trading is hard, it's because to be a good trader, you have to go against your human nature. And that plays out in fear, greed in the markets, and this is where patterns come. So patterns is just a reflection of human mass psychology, that behavior. Going on a little bit of a tangent, a little bit of a rant here, but this is just to explain that. So humans are creatures of habit. That goes into patterns in the market. We trade those patterns, and that results in probabilities. But you can't know who's trading at any time. That's why there's always some uncertainty there. So if the input and the output is disconnected, what does that mean? You can make the perfect shot, it will go in every time. You make the perfect trade, it can lose. So you can make a good input and it can result in a bad output. The whole idea of learning is that you make a good input, it has positive feedback, that results in you learning. If you make a bad input and it gets a bad output, that's negative feedback. That results in you learning. So that learning behavior, how you do that, you then learn from that, improve. You adapt your input based off that output and that feedback loop. That's how learning works. So if trading, if you make a good input and it results in a bad output, how do you learn? This is where a journal comes in. So if the micro is random, if trade by trade it's random, how can you possibly learn? This is where you need to have some sort of tool. You can be recording, can be taking screenshots, or you can have a journal. If you think of each trade as kind of like random here, where you might have like positivity of input, positivity of output, and you kind of want to get like across that, something like that. It's kind of like random, like here. If you get enough data points, you're able to draw a correlation. So It's kind of like in science. You have a hypothesis. Trading is very similar to science. If I do this at this time using this strategy on this pair, I expect this to happen. So it's kind of like a hypothesis. You have all these different variables affecting an outcome, all that sort of stuff, independent, dependent variables. I was never really very good at science, but there's lots of similarities there. So you need enough data points for that feedback to be accurate to be able to draw a conclusion on to get feedback on the average of all those data points. So the more data you have, the more accurate it will be. All that sort of information. So it's very similar to, I guess, like science, doing a test, hypothesis, all that sort of stuff. So if you make 1,000 trades and there's 100 trades of a certain input, and then there's a certain output of those 100 trades, that's accurate feedback for you to then review, learn, improve, and refine your system based off. You shouldn't be, it was hard, it's difficult, but you shouldn't be judging your system, your plan, your strategy based off each trade day by day. It's not sustainable, it's good for your psychology, and it's not accurate as well. You can take the same trade 2 days in a row. One might win, one might lose, and you might think, why? It might just be that you're unlucky. There's always certain little things that you can look at. Bit of a tangent on why we focus on a journal. Another thing as well I want to cover is that subconsciously, this is more like consciously learning, a bit of subconscious as well, but subconsciously, when you measure something, it gets managed subconsciously. And when you manage it, it gets improved. So think of when you're taking a trade without a journal, there's no kind of awareness there. There's no intention. You're just taking a trade. You might have a plan, but you can't tell if you stick to it or not. And then as soon as you go on to the next trade, you forget about it. When you have a journal that you're consistently updating, adding new data and collection to, you're subconsciously trying to take trades that align with that journal. Because if you take a trade that's completely random, how are you supposed to journal it into this? If there's no type 1, type 2, type 3, if it's at a random time, if it's not even on your pairs that you're trying to trade, there's no correlation, it doesn't fit in. So you subconsciously take better trades as well. In addition to that, if anyone here has issues with overtrading, this is another good tool because journaling is tedious. It's kind of tedious. Yeah. So if you're taking 5 trades, you have to journal 5 trades. That's very tedious. That's a lot of effort. So subconsciously, you will aim to take less trades, 1 or 2, because it's less effort to journal in as well. And then also when you're journaling, you're telling yourself that you're committed to learning because you always learn more from a losing trade than a winning trade, and you always gain something. Every time you take a trade now, instead of it being a win or loss, you're always gaining something, which is more data. A new data point to make your system more accurate and to improve. So it's really important. Yeah. And you have to stick to it. Like, you have to keep consistent with journaling your trades. I think I've covered some points in journaling quite a few times, but I'll kind of go over some things. I don't think I've covered this. So this is kind of like the same thing I've talked about. This is more sciencey. It's the Hawthorne effect. When a subject in a study or in an environment is being evaluated, studied, is being observed. So when someone's being observed, you might be observing yourself through recording. It could be through a journal, or just posting your trades. For me, that's all 3. So like I'm recording all my trades for content and for personal. So subconsciously that improves or changes the behavior of the subject just by being observed. So pretty nice tool in psychology to use to improve your trading. A bit more sciencey on that. But this is kind of more wishy-washy subconscious psychology part of journaling. Bit of the reasoning behind that as well. Like you have a plan, you try to execute that plan, then you evaluate. Okay, I've said this a couple times, but I've spoken to traders who've been trading for 1 to 2 years and they're very close to being profitable. I've spoken to traders who've been trading for 5 or 6 years, and they are nowhere near close to being profitable. Main key difference here is that the trader that's pretty close after 1 or 2 years, who's about 90% of the way there, they do all these 3 things. They have a plan that's clearly defined. They try to execute on that plan. You're going to make mistakes. You're human. But then they have a journal or they record their trades and then they evaluate. Then they learn from that and then go try to stick to their plan again, maybe improve their plan, and then doing that cycle. The traders that have been trading for 5 or 6 years and aren't anywhere near close, they just focus on execution. They don't have a plan and they don't evaluate their behavior. Because this is kind of like boring. It's like tedious, it's not flashy. They just focus on execution. Like they're trying to force the markets to be profitable. The hard work comes in the preparation. The actual trading should be effortless as well. Okay, so other point of having a journal is to get that objective data. This is kind of more subconscious, subjective, trading your intuition, learning from mistakes, all that sort of stuff. But this is more objective data collection and then refinement of that data, a bit more like data analysis, all that sort of stuff. So the whole point of having type 1s, type 2s, type 3s is just to be able to track, to define price action and then track how it affects the outcome or the output of trades. A type 3, a shift on itself has no positive expectancy. There's no edge there. But when you use this shift with your intuition, with validation, such as direction, such as area of interest, all that sort of stuff, you can find something, a unique combination of things that work, that suit you, that you're able to trade well with your intuition for a positive expectancy. So strategy doesn't really matter that much. Just choose something, you journal it, which is the most important part. You collect data, and you refine it into something that works. This approach gives you a lot of different tools to use for you to refine it into a way that works for you. But what does it kind of actually really mean? So you have a journal here, a lot of trades, this is probably maybe the later iterations. So maybe my 9th or 10th journal. But okay. The iteration before this, if you see the icon's a little bit different, and there's no type 3s. There's no time frame type 3s or type 1s, type 2s. There's no DXY correlation. There's no wick sort of stuff. Because we get better at this is me getting better at journaling or adding more things, learning to refine or add, subtract things from my system. You're always kind of experimenting, seeing what works, seeing what doesn't. If you just see the losses here, there's a lot more losses. Then if we go into here, adding in more low time frame complements, entry models, that type 3 shift, there's improvement, pretty big improvement. Then when I go into adding confluence, DXY, pair confluence, there's some more improvement there. You're adding things in, removing things that aren't working, and how do you kind of know what to do, what to add, what to remove. You have a win rate, you have risk to reward, you have all these variables that you can track. So this would give you, if you're not sure, what pair should I trade? When should I trade? Should I trade with DXY correlation or confluence? Should I trade wick fills if there's no wick? This will give you objective data, like an accurate answer to all those questions. This is the most important thing. This is one of the most important things. It's not the flashiest. This is a Friday, but just think about the amount of people that are here listening to it now compared to on Tuesday, when I was talking about AOIs and areas of interest, which is, it's kind of important. You have to be that accurate with them. But everyone wants technical analysis. Even the polls, everyone votes for technical analysis when we all know, we kind of know that technical analysis won't make you profitable. It will fail because of their behavior. Everyone knows this. This is the most important skill. But how many people actually rocked up here, voted for it? These kind of people, you guys right now that are here, have a higher likelihood of succeeding because you're focused on the right things. So good job. Pat yourself on the back. Nice. But sorry for that tangent again. This will tell you what to focus on. So I have all these different things. Let's say we'll start off with something bad. So think of like all these things are kind of patterns. Type 3s, type 1s, type 2s. They've come through me seeing that keep on happening again and again and again, and then I define it, put it in a journal, and then track it. So, wick fills. I used to love to take a buy. Let's say I'm looking to take a buy here, and we have like previous bullish candle close, and then price opens, and then lots of volume comes in. You immediately push bearish. Lots of volume. Maybe this is a daily, and like you've immediately pushed bearish here, and I'm like looking to take a buy. Maybe we've like broken a previous candle low, looking to take a buy here to like fill that wick. I would like hyper fixate on like just that wick fill, because how often do you see a daily wick without like a daily candle without a top or bottom wick? Not that often. And I try to like enter on the 1 minute to have that wick fill in the daily. This is my kryptonite. So if we just 35% win rate, that's kind of crazy. Crazy bad. So 35% win rate really isn't that good. And let me just think why that is. Okay. So when there's no wick, when you have it immediately push bearish, that kind of means that volume is moving in a certain direction. So I'm always trying to trade with volume, not against it. So me taking a buy here to have that wick fill, especially on high time frame candles, such as the 4 hour of the daily, that's when I had the lowest win rate. So I can be now more aware of that, more careful, and then stop doing that. I thought this, taking no wick fills, improved my win rate, but it did the opposite. And I only could have known that through this journal, objectively. Maybe I had a subjective feeling, but this gives me clear data that I should not be doing that. Okay, but let's say positive now. A lot of people say DXY is confusing. Why do I give so much weight to the confluence of DXY? Simple reason is because subjectively I feel confident when I'm trading with DXY. So you always have that subjective and that objective. There's two parts of improving a system, but you kind of want those two align. So it's subjective and objective. You want that to align. So I feel more confident when I'm trading DXY. If I just add that in, that's now went from 56% to a 73%. That's a pretty big increase. So just through that one thing. And like, what should you refine? How much should you refine? You can over refine, you can under refine. With anything, less is more. What's the least amount you can do or focus on to get the best results? Simplicity is the key. So me just focusing on that DXY correlation has a very big increase in my profitability. So I'll just focus on that. Now I have these different types of entry models. What should I focus on? If I just put in a 1 minute type 3, now that's another 10% bump. That goes to an 83%. So a pretty large increase, pretty nice increase. So me just focusing on that 1 minute shift of structure with DXY correlation has a very big bump or increase in my profitability. Even like 5 minute type 2 is pretty decent, 79%. This is kind of more rare. That's a pretty big bump. And like some things would kind of be like not the clearest. So we go this with some DXY. So when there's 6 or 7 timeframes aligning with DXY, 80% win rate, so another positive correlation. So I want more timeframes to align than not. I want to take it with ideally 1 minute shift with DXY correlation. This is you like getting clarity around what works, what doesn't, objective data. And then once you know, you don't even need like one pattern to like make a bunch of money. You refined it. Then if we kind of go back to here, once you like, this is how you find what works. Yeah, 7 timeframes align, 85%. Like if you have every time frame aligned, these are the best trades. So like crazy good trades. They're very rare though, I find. The better the trades, the higher quality, the rarer it tends to be. There's always going to be a trade-off between quality of trade and frequency that it occurs. So this is about like finding like objective data to find an actual edge. You need an edge to be profitable. You can't just take random trades, unfortunately. So it's like having actual objective data to be able to have confidence as well. Like if you lack confidence, or if you have anxiety, if you doubt, or if you struggle to stick to your plan, it's very easy to be confident when you have a stack of evidence in your face that like tells you if you just make certain actions, you get certain outputs. Like a DXY with type 3 gives a extremely positive expectancy, so it's easy to be confident and trade with confidence, which is what you want. But when you have something that works, you then move on to more developing your psychology. But having a journal, having a plan, having objective data where you know you're taking decisions based off evidence, you're not kind of bullshitting yourself, because you can't really lie to yourself. You know, because it's you. This will fix a lot of the psychological issues. Most of the traders I speak to, they think psychology is their issue, or the problem, but it's just a symptom. Their technical analysis, risk management is the problem, because they don't have a plan and they don't journal their trades clearly. The work comes in the preparation, having a plan and journaling, not in trading. Taking thousands of trades without tracking it, evaluating it, journaling it is a waste of time. You might improve your intuition a little bit, but you're not really getting that accurate feedback. And don't trust your mind. We are incredibly biased. Recency bias, information bias, availability bias. This is why it's so hard to be consistent in trading, because you're always working against these biases. So write everything down, document everything. Don't trust your mind too much. And then you move on to more psychological. Another great way, outside of journaling, to improve is just through recording yourself, recording your trades. It doesn't have to be through like content creation, but it's really nice to look back at the trade in that moment to see how if you it's just good for, this is like better for training your intuition. If we like make a this is kind of dumb, but in League of Legends, if you've ever played that game, I apologize. It sucks up much time. I'm sorry for your loss, but League of Legends is like highly competitive, and like some people are hard stuck where they're not very good at the game. Some people make lots of bounds. They get to diamond. They get really high in the rankings. It's simply like being more prepared, doing the work. Reviewing is one of the massive like ways to improve in anything, in any skill. So if you wanted to get good at League of Legends, you'd play a bunch of games, and then you would review those games afterwards and see what you could have done better. This is like active learning, active recall. This is like how you actually get better. So you do the exact same thing with trading. When I used to play rugby, I would review my games, watch them back. The easiest way to get better is just to review and watch things back. Same as kind of journaling. That's better for training your intuition than just taking trades and then moving on to the next one. So that's, yeah. Then when you have that data, you kind of want to start off broad, I guess. Try out lots of different things. Experiment, see what you like, what resonates with you. You can take breakouts, you can take pullbacks. It's just like how you look at the markets. We're never trading the markets here. Like we're never accurately seeing reality. We're never accurately trading the markets. You're trading how you see the markets. So I have a major sell bias. I see the market differently to someone that has a major bullish bias. So you're always looking at different markets to someone else. We'll have different biases, beliefs, all that sort of stuff. So start off broad. So I used to trade 2 pairs. So I used to trade JPY and gold. I used to trade Asia and London. I still trade London. It's just like the core strategy, like the simplest way to be profitable. Asia and London. Used to have like lots of different entry models, different time frames, all that sort of stuff. Yeah. So like 2 different strategies. But you're testing all these different things, like what you trade, when you trade it, what kind of like system you're using. It doesn't have to be like a strategy. It can be like an entry model. This can be like continuations. It can be reversals. What I tend to find is that I'm a little bit better at continuations. So I have so many different variables set up. There we go. High time frame continuations, 67%. That's a pretty good bump there. High time frame reversals, not really much of a positive expectancy on that. Low time frame doesn't really matter because I might be taking a low time frame reversal with a high time frame continuation. That type 3 shift is a lot of the time on a reversal. So low time frame continuations, I don't really trade that as much, not as good. So ideally, like taking a low time frame reversal with a high time frame continuation. Maybe like have a downtrend and then you're like in like an uptrend on like low time frame. You have like an area of interest here, an area of interest here. Then you're like on that pullback. This is like low time frame bullish, high time frame bearish. You go into that area of interest, you have a shift. That would be a reversal, but that's a continuation on high time frame, reversal on low time frame. Very nice setup. So remember, you're not trying to win trades. You're not trying to like make money. You just try and do the same thing every day. That's the only focus. Yeah, and these work really nicely. Very simple, very nice. Today, like that was a low time frame reversal, high time frame. It was just like a little bit messier. Like you had something like this where like you kind of like messing around a bit, and then like you had that. You didn't really come all the way back to like the previous, but that's kind of what you had. Bit of a pullback. So you might have multiple, but start off broad, and then I find that the best way to improve is through subtraction. We all think adding things in will make things better. That tends to overcomplicate things. So you want to keep it simple. If you're going to add something in, add in one thing at a time and see how it works. Less is more, as always. So might be trading still might be trading UJ and gold at Asia and London, but now I'm only trading continuations. Okay, go down to the next one. Now I'm only trading Asia, still UJ and gold, and still continuations. I'm only trading gold at Asia, taking continuations. And like this, ideally you want like positive expectancy or expected value of each decision. Do the other way around. Expected value. So like every trade, or maybe just win rate as well. Win rates increasing. So this might be like 50%. This might be like 55. This might be like 65. Maybe that's a big bump. And then you have like 70, maybe 80% on good setups. That's how you like improve a system. That's how you get profitable. That's how you get more profitable, not through a strategy. Because remember, like, oh my god, you have to get like everything is a skill. Going back to that, everything is a skill. Like trading that type 3 shift with like a continuation, this is a skill. Remember, the only thing that makes it all work is your intuition, is you. You are the thing that makes it work. It's not the strategy. So yeah, this is how you actually make something profitable, make it work, make it get better. This is how you improve, have like tangible improvement through that refinement, to like understanding actually what works, actually what makes you profitable here. You don't have to do this like journal wise. I find a lot of value in recording, posting my trades, all that sort of stuff. Like subconsciously, I still get all those effects. So, and I've refined it all the way down to this, so I don't have to journal as hard or as heavily. Maybe if I go through a bad period, I'll get back on that. But there's like lots of different ways. So journal, easiest, best way to just get to this point as quickly as possible to find what works. Recording your trades, really good way to train that intuition, to have a look back on that as well. But there's no point of recording it if you don't like rewatch it back, which is what I used to do. But it's a lot easier to get into a good habit around this when you're creating content, which is a positive as well. So journaling your trades, recording that, feedback. So posting your trades in the Discord, getting feedback on that is another really good way to improve, to maybe learn why, or if you made a mistake on about direction, maybe it wasn't a great area of interest, or the entry model wasn't that good. All these things give you a massive benefit. Okay. So yeah, if you have any questions or if you want like feedback or anything, let me know as always. But I've kind of I've been through like taught this a lot of different times, kind of refined this teaching as well, gotten a little bit better at it. But this is kind of it. Like if I was to learn trading again, this is how I do it to get there in half the time. So experiment, find what you like, how you like to trade, what resonates with you. testing, practice, refinement. Backtesting is good for quantity, but if you actually want quality of data, forward test or have a small live account trade on that, because you want the practice to be as close to the execution of the skill as possible. So my backtesting results always differed greatly, extremely greatly from live conditions. So this almost made this almost useless. Mainly for like purely technical intuition, it kind of helps, but yeah, I think it's a bit overhyped. Like, I guess like everyone says to backtest. 95% of people say to backtest. But like the crowd is everyone like the crowd's always saying to backtest, but the crowd isn't profitable. Like most people aren't profitable, but they say to do certain thing. So the easiest way to, I guess, do that is just do the opposite of what they say. Like focus on, I'd say this is like you want quality. You always want quality. Yeah, it's good. Yeah, it's good for getting that baseline, like intuition. I agree with that. But I think most people backtest too much. Like it has a point in time, and then you move on to this. It's not gonna like detriment your trading. It's just it's a good stepping stone, I guess. Yeah. So I guess for recognizing backtesting, that's a good point. Backtesting is good for like trading the intuition straight away to be able to recognize patterns, and then you move on to more forward testing. That's like around that collecting that data, that refinement should be focused more on this, ideally with money on the line. So there's training that psychology, and then you move on to more focusing on scaling up, small live, gradually increasing the risk. I think I've covered this as well, but yeah. And yeah, you just want it to have a clear defined edge. You want to be at it. You want the system to be as clearly defined, have as much clarity as possible in it, and that'll make everything easier. Then you want it to be personal to you, so it has to fit into your daily routine. It has to suit your unique psychological makeup. This is why strategy is always limited and kind of shit, because conditions change. Everyone has different routines, schedules, psychology. So teaching one mechanical approach doesn't really work because of all those different things. This is why like the approach is so broad. Like you can trade this on any pair at any time. On like you don't even have to use type threes. You can use type ones, type twos, and refine that, stacking multiple time frames, taking continuations. You can trade a shift on a breakout, on a pullback. You don't even have to use the 1 minute. You can look for 15-minute shifts. It's just a broad approach to be able to like define and find what works for you. That's kind of the whole point of it. Yeah, I should have named them better though. Oh well. And just like learning from other people's mistakes makes everything a lot quicker. Makes it easier. Yeah. So a lot of the stuff like I kind of like have I guess like maybe a period of time where I'm losing or I'm not trading as well. You kind of like have a subconscious feeling. Maybe something changes. Like you trade at a certain different point in time. Sometimes you need a string of losses to like find a way to improve, as well. I look at it as you have candle behavior. So the movement of individual candles throughout the life cycle of a candle. How does a candle move when the previous one has closed bullish, which is more kind of micro in this time frame. Then you have macro, which is market structure. So price action can be broken down into two things: candle behavior and market structure. And this is on every time frame. So it's very complicated, lots of little details. But I'm always looking at candle behavior of the micro individual candles on a time frame and the macro market structure of that whole time frame. You can always like zoom out and look at this larger time frame structure, where that's like larger time frame market structure. If I go to week, that would be candle behavior. So prices is always fractal, connecting different time frames. The whole point of this approach is to align different time frames to stack probabilities and confluences in your favor.
So what this 15-minute type 1 might look like on low time frame market structure. So you have candle behavior here. On market structure, it'll look like your type 3. So you're connecting candle behavior, market structure, using that to connect different time frames to align them. And this might be a little bit confusing because I'm trying to explain my intuition, a gut feeling. Intuition is what you can't necessarily put into words. So it will be a bit different. So ask lots of questions. If you're not sure about certain things, ask me to clarify, as that will also help me out as well. But you have candle behavior, market structure across different time frames. Each time frame can be broken down into the micro candle behavior and the macro market structure. There's this structure here that's in context of this larger structure here. You can look at it through the 4-hour candle time frame of market structure, or you can look at it through candle behavior as a weekly type 1. You come to the same conclusion. So type 1 close bearish, pretty strong close here. So that'll be looking kind of bearish. You're looking kind of bearish. Maybe you're looking to take a sell around this level on the weekly. If you're going down to hourly or 4-hourly, you'd be kind of looking for like a sell around there, which would be around a previous low. So candle behavior and market structure, you're looking at the same thing, just through different lenses, micro and macro of each time frame, and always being aware of like it's a move within a move within a move. It's always fractal. What happens on the small time frames? So what happens on the 1 minute happens the exact same way on the 1 hour, the 4-hour, the daily. So this is where trading can get really complex, because is direction bullish? Is it direction bearish? Is it bullish? Well, it might be on one time frame, but it could be bearish on the 1 minute, but in actuality, it's an overall high time frame uptrend. So it might be good to take a sell around here, not so good to take a sell around there. And the tricky thing is that a lot of people get trapped in. This is kind of like when you're taking a sell here, it's kind of like reversal counter trend. It's not too sure. If you're looking for a sell, you're not too sure about this. A lot of new traders or a lot of traders, retail traders, will be looking for buys because it's pretty clearly an uptrend. But when you're like looking for sells here, you're going to get a pretty good trade. But when you're clearly it's a downtrend now, it's clearly a downtrend, you're looking for sells, you might have entered too late, and it could be a continuation of the uptrend. So you always want to be mindful of or aware of higher time frame structure. And that move right there could be just a part of a even higher time frame move down. So it's really tricky connecting different time frames. There's so much complexity there, but I'm going to do my best to try explain my gut feeling. So today in the Discord, I posted low time frame bullish, high time frame bearish. What does that kind of mean? I'll kind of clarify that. So thinking of time frames, this point of time, you're on the 4-hour. Depending on how far you zoom in or out on the 4-hour, most of the time you're talking about a week or a couple of days on the 4-hour chart. So don't look at time frames of just 4-hour candles, 4-hour charts. Look at them as periods of time. I'm not trying to trade a certain move. I'm trying to trade the next 10 minutes, that sort of thing. You're trading a period of time. This is why when I say I exit early when it's ranging or low volume, I don't want to be in a trade for too long, because I'm only trading the next 10 minutes. If the move doesn't happen how I want it to in the next 10 minutes, that's no longer a part of my edge. So you're not just looking about where price action is, you're looking about when it is. So when are we in the daily candle? When are we in the 4-hour candle? So it makes it a little bit more complex. You're always looking about, so where are you in market structure wise? Could be also candle behavior. But when are you in the day? So first half, creating that daily top wick to have a bit of a shift, push. Or when are you in the 4-hour candle? Are you in the second half or the first half as well? So I used to think about you should just purely look at price action. And I used to get stopped out a lot and not understanding all this sort of stuff. But that's just because I didn't understand when. If you just remember, the markets are made up of people. Yes, you have like bots, all that sort of stuff, but mainly the markets are made out of people. People are creatures of habit, so their habits result in patterns in the markets, and we trade those patterns. You may have habits that tend to be in a certain periods of the day. So I have a major habit of, as soon as I wake up, I have coffee at a certain period of time. Around 11 a.m., I'm in a major habit of trading. I've gotten into that point. You even might just feel hungry around certain periods of time. We are creatures of habit. I feel hungry around 11 or 12, then around 3 or 4. We're creatures of habit, so that's always time-based as well. That habit is time-based. So you'll see certain patterns play out at the same time. This is why we trade the second hour of Asia at the same time every single day. Because where or what's happening is time reliant. When is it going to happen? Around that second hour, sometimes the third hour. So hopefully that kind of makes a little bit more sense around like why I'm so like, if you want to be consistent, you need to be trading the same thing at the same time every single day. You don't have to be trading the second hour of Asia. You can trade the third hour of London, another point in time. It's just important that you stick to one point in time each day, maybe on a couple of different pairs, because you'll start to see certain patterns at certain periods of the day. So it's really important. In London, you might see big reversals and swings, where like you might just, if you're going in a certain direction, trending in the first half of the day here, I tend to find around that London Open, you have a reversal. If you have like a really strong direction in Asia, you're going to have like a strong reversal and correction of that in London. So if you're trying to trade multiple different sessions at different times for really long periods of times, that just makes it really hard. Remember, less is more. You're trying to keep it as simple as possible. What's the least amount of things you can do to get the best results? So you want to be a specialist as well. Bit of a rant there, but yeah. Hopefully that kind of maybe makes it a bit clearer around. It's not just about where, it's about when in the first half of the day. And I'll kind of go back over. I've done this lots of times, but how to find when? How do you find when? How do you build this up? Like, that's kind of tricky. It's let's say you've been extremely bearish here. You have a bearish candle close, and maybe you're kind of expecting it to continue bearish. Maybe high time frame wise, it's a downtrend, and you kind of like this. This is kind of like market structure wise, yeah. And you have a previous daily close bearish. So candle behavior wise, you're looking forward to create that top wick in the first half of that candle to pull back, and then push in that second half. Why is that? Price likes to fill its moves. It's always going to be a push and a pull. Price likes to fill its moves around 70% of the time. Always think of like that elastic band. Bigger the push, might snap it back like that, like you saw in London today. So always keeping in mind that push and that pull. If you have market structure like this, maybe this is like the same day. This is the same day. This is one candle. This would be like the daily time frame, whereas this might be, I don't know, the 30-minute / hourly time frame. So you're looking at the same thing. So don't look at time frames as different. Try not to look at time frames as different. Like if you think like I'm really good at trading low time frame, but I'm bad at trading high time frame, that's just like either a limiting belief or you just don't understand how time frames work. You're not looking at anything different. The lower time frame you go, so let's say I'm looking at the 1 minute versus the 1 hour. And I'm looking at one candle. So we use the exact same thing here. The lower time frame you go, the more detail you are seeing. You're turning up the high definition. You're always seeing things, the same thing, just through a different lens. So this might be like 480p, so like standard definition. Then this might be like, I don't know, 1440p. Lots of detail, almost sometimes too much detail if you're not used to it. Where maybe the daily, that's like 240p, less detail. You're seeing the same thing. What I mean by that, this might be like, you might have like a push in the first half to create like a bit of that top wick, and then you might have like a pullback here. So like structure wise, that might look like that. Maybe you have some pullbacks in between in that structure here, but that will be simplified into that one candle where you have the open, the high, the low, and the close. So market structure, candle behavior, you're always looking at the same thing. Candle behavior is just going to be a bit more simplified. It's a bit easier to find timing in that, because in that first half of that candle, you're looking for it to create that top wick. If it's a day, it's the first 12 hours. If it's a 4-hour candle, it's the first 2 hours. It's not a black and white first half, second half. It can sometimes be the first couple of hours, maybe the first hour. Just kind of looking forward to first have that push and then that pull, or pull then push as well. So yeah, the lower time frame you go, the more detail you're seeing. The higher time frame, the simpler it is. So if you're not sure if price action on a certain time frame is very messy, it doesn't really make sense here. It doesn't really make sense, or it's like too much. You would just go down into, or go up into high time frame to clarify some of that, where like this is a pretty clear, just like break and retest, all that sort of stuff. So it looks a bit smoother. You're smoothing it out. Yeah. So if you're like extremely, yeah. So I'd try to follow what's in front of you. You can follow the trend. Like most of the time, it is a bit easier to generally follow the trend. But like, where are you in that trend? Like, if you're ideally, you always want to be buying below the open and selling above. So if it's like an up, like if you're in a bullish trend, you're like, you're trying to buy below, or like when it's stretched a bit. So if this is like a high time frame candle, like closure, if it's a new one opening, you're trying to buy like below an open. So if you're like around this area here, like in like pullback area, or maybe even around here, that's okay to buy. Like when you're trying to buy like around here, yes, you're in an uptrend and it's looking very nice, all good. Depending how strong the uptrend is, it's never just a trend or not a trend. It's like percentage. Is it like 0% uptrend, 100% uptrend, which is kind of rare? It could be like 50% like high time frame downtrend with like really strong low time frame uptrend. Always keep in mind that larger time frame structure. If you're trying to buy around here when it's overextended, I tend to not like those areas, because you said you're trading with like high time frame. It's good to like buy around here, or maybe like go into low time frame, but where you're going to place your stop, kind of overextended, so pushing that pull. If it's in the later half, if you're around London, and you've pushed up for the first half of that day, and yes, you're bullish, I might look for like a reversal counter trend. But if it's really high bullish trend, I'd look for a clear shift first. So like you're trying to stack confluences. You're always going to have pros and cons. So there's always going to be a reason not to take a trade, and there's always going to be a reason to take a trade. So this is a bit crude, but think of it like I always talk about, like you have entry models. You have type 1, type 2, type 3. You have direction. You find direction from entry models. So, but you're finding direction from areas of interest, from candle behavior, from market structure. Where are you in a day? When are you in a day? So let's say, give an example here. If that kind of answered like the trend second half of the day. But okay, way too many drawings. So you had a previous day bearish close. So you can like have pros and cons. Let's see. Okay, so you have like this balance beam here. You had a bearish daily close, but high time frame wise, you kind of overextended. So let's say this is for sell, this is for buy. This side. This is how I find probabilities. This is kind of what I'm constantly doing this in my head, to find like probabilities. This is how you like kind of get a probabilistic mindset. So I had a bearish close. This is for a sell. This is for a buy. But we're kind of overextended. So high time frame wise, it looks like a sell. But I'm trading the first hour of Asia. So looking forward to create that daily top wick first. So one for buy. If I go down to 4 hour, we had a 4 hour bullish close. If we just go down to the next one, sorry. So you're trading the second hour. That's a pretty strong 4 hour bullish close. So another buy. If you go to hourly, buying kind of at, you kind of overextended at like a peak, you're probably going to get a pullback. Yeah, I can wait for a pullback. So maybe like you just had a big push. I'm not really going to say this is like half a confluence, but you had an hourly type 2, another one for buy. Had a 30-minute type 2. I don't really like that there's no bottom wick here. I do that for sell, just purely confluence gut feeling. Go down to 1 minute, pretty clear uptrend here. but you're kind of in a previous area of interest or low. So 1 minute there's an uptrend, but you're kind of at an area of interest or low, but you're still looking bullish here. So like low time frame bullish, high time frame still bearish, but I'm trading the next hour, next 10 minutes. So the high time frame doesn't really matter, even though it's bearish, because like you need to go bullish first before you go bearish. Then we look at DXY. What is DXY looking like here? DXY is, if you go down to the high time frame, this is looking kind of high time frame bullish. Why is that? Because you had a pretty big push down, you reacted that there, but you also kind of broke this low time frame high. So if I'm looking for a buy on gold, I want DXY to be bearish. So that's one for sell. That strong of a confluence though, because I'm sticking to like low time frame. I'm trying to trade the next hour. So this, how long is this? This period of time here, so where you make a high, break a low, kind of break this low time frame high to here, that's like a week of structure. So a week of structure doesn't matter if I'm trading 1 hour of it. So pretty weak confluence. But if we go down to 1 minute time frame wise, you're in kind of a downtrend. You're making low lows and low highs. Price action is around here. You're making low lows and lower highs. Pretty clear 1 minute downtrend. So that would be on for buy on gold. But I was also pretty mindful of this here. I wanted it to respect these highs. If it broke those highs, I would either look for a sell or I wouldn't look for a trade. But what happened? You had a pretty strong break of that, a pretty strong reaction to that area of interest. And you had a type 3 shift. So I'll give that a 2 extra weight for that buy. So what is it looking like? This is pretty shit. But a lot more for buy and not as many for sell. So probabilities are in my favor to look for a buy. So what did I do? I took a buy at an area of interest, stopped below the low. Probabilities are in my favor. Doesn't really matter what happens next. Whatever happens, happens. It's like kind of like a brick and retest. Not the best entry. But God, it's so much drawing. But here, it was just a buy at this previous level. Stop was below this 30-minute candle low and open. You find that down to 1 minute structure. What that looks like is that 1 minute low. So you're just looking at the same thing. Like this is what I said. Like, yeah, candle behavior, market structure. It's the same thing, just through a different lens. The more detail, you're kind of seeing like how it created that low on 1 minute, whereas a 30-minute, it's just simple. So hopefully that like makes sense as like finding a level as well. But yeah, this is what you kind of want to think about. You're just going to have pros and cons. You're trying to stack more in your favor than not. And that's how you find, like, if you just mentally do this every trade, and then you just accept that probability is in your favor, like, the more I stack, the higher probability. So this is like maybe a 50, 60, 70, I'd say 60, 70% chance, because you have quite a few stacked. That sort of stuff. You can even count this. Like, you can count how many have you put on bearish, how many have you put on bullish. You can journal it and see how that, how the amount of confidence is stacked affect that. But like, if I just get up the journal, you have each of these can be a block. It depends how do you like want to weight the block though. Because so like, this is 2 times the weight, this is 1 times the weight. I might give more weight to DXY because I found it has a bigger likelihood of increasing my win rate more. It's more important as a confluence. I give more weight to that confluence. So you always have this balancing beam in your head to stack probabilities in your favor. This is like when we talk about a probabilistic mindset. I'm taking a trade that I think has like a 60% win rate, 70% win rate, depending on how much I stack. If you stack the whole fucking board, let's say you have everything aligned, you're likely to have a pretty high win rate. These are going to be kind of like rarer. So yeah, nice little thing to think about. That's kind of like what I'm visualizing. Hopefully that kind of helps clarify that. But yeah, so like I'm always thinking about trading in the next period of time. like direction. It's not like low time frame directions bullish or high time frame directions bearish. It's the next hour or two. I'd say the next hour or two, yeah, is bullish, and then the rest of the day is looking bearish. That's kind of what I think about like low time frame, high time frame. It's a period of time, not just a time frame. You're not thinking about like this structure as what it is. You're thinking about it as what this move is like 2 hours. And then you can like find what you're good at. I'm really good at trading the next 10 minutes to the next hour. Anything more than that, I'm not that good at. And then you start to give weight to different time frames. I found whenever I'm overly focused on trading with the daily time frame, so like this daily was a pretty like it was a closed bearish here, and I was looking for sells in the first half of the day, or in Asia session when I was looking for sells, because like daily closed bearish, so high time frame is bearish. Like this is all like very clearly bearish. And I'm looking for sells, so I'm trading with high time frame, but I keep taking losses. It keeps going bullish when I'm looking for sells. Why is that? It's because when are you? You're in that first half of that day. It's likely to create a pullback first to then have a push. So being really mindful of when you are. It's not just that like you're trying to trade with high time frame. That high time frame has to be like within that period of time, or you have to have a really fucking big stop loss. So this is why like trading the 1 minute with the daily is relatively difficult to get it to align. You have to be very patient. This is why I can trade against that daily high time frame like bearish by like using it to look for a pullback, stacking that. So hopefully that kind of like clarifies that, because it's like it's difficult to get different time frames. Because this might look bearish, you might take a sell, and then you might have this move here, and you're not sure what you went wrong. It's about that timing. It's the wrong period of time. Okay. Yeah, push and pull a price using those probabilities, that balance scale in your head. You just want more to be in your favor than not. You don't have to put a number or overly do it, just in general. That's how kind of intuition, that gut feeling works. Brett Steenbarger talks about this. You have like this thing called like biomarket feedback. You have a gut feeling. You're either feeling bearish, you're either feeling bullish. Don't disregard that. If you have like a feeling, I was feeling low time frame bullish, high time frame bearish, then look at price action to think why that might be. And then stack confluences with that if it aligns with that gut feeling as well. Like use your gut feeling as a confluence as well, if that makes sense. So, and most of the time, I find my intuition is right more often than my analysis. Sometimes I have a gut feeling in a certain direction, then I overanalyze, go in the opposite direction, and then I lose, and I should trust my gut feeling. When that happens, more than not, my intuition is right. So look for, you can trade based off fear, you can trade based off, I wouldn't say hope, hope's a bit tricky, but you can trade based off fear. You can exit winning trades early if you're getting fearful, but that's a skill. So you can exit winning trades early based off fear if that fear is based in reality. It could be an air of interest that it's kind of testing, it's not really pushing through. It could be that volume's decreasing, you're not getting that push through or how much you expected. Or it could be that DXY is just not looking how you wanted it to look. And it's all about like understanding where and when you are in that move. Like think of, we're trading like type 3s again and again and again. The reason, so much fucking drawing. The reason why my take profit was a bit higher was mainly because the range was like it was bigger, moved down as well. So think of it as elastic band. The bigger the push, the bigger the pull. But also you had the DXY. You were entering off a break of a low, like around here, off this DXY, like a strong reaction here. So if you're thinking that a type 3 is happening in this period of time here, you're going to have a pullback and hopefully a push off that, so you can hold a bit longer for the completion of this move on gold as well.